Hello, my name is Chris Cogswell. I'm representing Eastern Michigan University. Most exciting was getting to learn about an industry that I knew nothing about. I'm not in a position right now where I do a lot of research, but getting to learn a little bit more about other industries out there can help with broadening my horizons and also expanding what I know about the economy, I guess you could say. Much harder, much harder. We did speak to the presenters from our school last year, gave us a little bit of an indication of how it was going to be, and it was much more difficult, but it was definitely a great challenge. Just speaking in front of high-level executives as well as CFA charter holders will help with confidence. Also learning what it takes to really be a CFA charter holder, and just the work that goes into stock analysis and that sort of thing. Absolutely. After talking with presenters from last year and our mentors, this definitely represents, I think, what a real world view is of stock analysis and research.
As you can see here from the chart, ladies and gentlemen, investing in Herman Miller over the last 10 years has resulted in no increase in shareholder value. Consequently, this causes us to recommend a hold. Good morning, my name is Robert, this is Michelle, and this is Chris, and we're from Eastern Michigan University, and we'd like to thank you all for being here today. We believe that there are 4 key factors that support our recommended hold. That is, the first is decreasing commercial and government revenues, which happens to be the largest revenue segment for Herman Miller. An unproven international growth strategy in the Asian Pacific region, and revenues from new product introduction continue to be not significant, as they only represent 24% of total revenue. And unfavorable macroeconomic factors. This is an area that Herman Miller has also stated would be a threat to their ability to grow revenue. Michelle will now take us through the first 2 factors.
With an increasing government deficit and a high U.S. unemployment rate, along with a -8% compounded annual growth rate, in the office segment, we anticipate weakening commercial and government revenues for Herman Miller. As shown in management's 2011 business overview, home health and education has grown to make up 24% of revenues, while the international segment declined 3%, along with the government and U.S. office at 22% since 2001. But with the further look into Herman Miller's 2011 10K, we recast actual government revenues, which we expect to decline from the expiration of the GSA contract in December 2012, along with the compressing industry, putting pressure on Herman Miller's margins. We also expect the U.S. office to continue to decline from the recent unemployment rate, reduction in construction and credit availability, along with the increased volatility in the economy, all leading to our skepticism. As we can see over the past 10 years, Herman Miller's U.S. market share has been maintaining a 10 to 15% level, a factor claimed to drive growth. With the weakening U.S. economy the last 3 years and strong competition, we do not expect the company to acquire additional market share in the short term. With China's economic growth on a decline from 25% to 7%, and Herman Miller's unchanged international sales from 2001 to 2011, we question if the acquisition of Posh and the Asia Pacific expansion will have any major significance on their revenues. Although the company and stockholders have been eagerly awaiting the acquisition of Posh, we do not believe the 2010 company 2010 revenues of $50 million Posh had will have any significant impact on Herman Miller's revenues in the short run. Since the relationship began in 2008, Herman Miller's international sales have been between 15 and 18%, which is right in line with the prior 7 years, reinforcing our skepticism. At the same time, product rollouts and macroeconomic factors are affecting their company, which Chris will talk about.
Thank you, Michelle. Good morning, everyone. As Michelle stated, the first sector I'd like to discuss is the flat product rollout for Herman Miller. In the 2012 industry or investor presentation, they noted that one of the large growth drivers for the company is their breadth and depth of new product rollouts. As you can see from the slide, 2010, they introduced 18 new products at Neocon. R&D investment was around $33 million, and they generated about 23% of revenues from products introduced in the last 4 years. Compare that to 2011, they introduced 13 new products, which is a decrease from the previous year. R&D investment remained flat, relatively flat, at $35 million, and that generated about 22% of revenues from products that were introduced in the past 4 years. Though many of these products were introduced in the home, healthcare, and education sector, which appears to be the sector that is growing the largest for Herman Miller, we believe that this does not significantly change for the decrease in the decrease in the government sector. Next would be the unfavorable macroeconomic factors. As you can see from this slide here, Herman Miller's stock price has remained relatively constant compared to the GDP growth rate over the past few years. With GDP growth expecting to remain flat or relatively stable in the next few years, we're expecting this trend to somewhat continue into the near future, which leads to our skepticism as well. Next is the commercial real estate vacancy rates. Now, considering Herman Miller, the majority of Herman Miller's industry happens to be in companies that take up office space, with the flat to modest increase and decrease in vacancy rates, we believe that the companies that would be taking up new real estate would not be spending capital expenditures on new office furniture and new equipment, which helps us to believe that that segment may not increase enough to overcome for the decrease in some of the other areas. Oh, pardon me. Lastly is the industry projection from the Business and Institutional Furniture Manufacturers Association. Now, in early 2011, BIFMA made a projection of about 14.3% increase for the industry for 2012. However, in December of this year, they recast that estimation and are now expecting a 1.7 decrease in the industry. That also helps us lead us to our skepticism. This decrease also leads us to believe that this will put downward pressure on the margins that Herman Miller will try to or are going to obtain, and they must work harder to maintain the current margins that they have. I'm now going to turn it over to Robert, who will discuss our financials and our valuation.
Thanks, Chris. For our valuation, we use a discounted cash flow model to come up with an estimated stock price of $21, which puts our estimation right in line with the current market price at the time of $21, at the time of our report. As Chris and Michelle has stated, there are 4 factors that we played into our assumptions. The first, again, was decreasing commercial and government revenues. We believe that Herman Miller will experience continued price suppression given the current projected economic growth rate of 3.6% in the years 2013 through 2016. BIFMA also confirms this with their projection of a 1.7 industry decline this year. This will put pressure on profit margins. Next is the challenges of an unproven international growth strategy. An example of this is their relationship with Posh that they've had since 2008. This relationship has proven to yield no significant additional growth, revenue growth to Herman Miller. And third is the additions of new products. The new products have not only represent about 24% of total revenue for Herman Miller. And lastly is unfavorable economic factors. This is an area that Herman Miller has themselves indicated would be a threat to their ability to grow revenue. Also, Herman Miller is a cyclical business which depends on growing economies both domestically and internationally. Chris showed us earlier that the stock price is positively correlated with GDP. This being said, GDP is projected to be flat at 3.6% over the next 4 years, and as a result, we believe that Herman Miller's stock price will continue to be suppressed as a result, and we feel that this supports and confirms our hold position. We put together a sensitivity analysis to show the changes in sales growth and profit margins. As you can see here, a 1% change would change the stock price to about $21.67. What would change our recommendation or our position would be if sales growth were to grow faster than we anticipated, if Herman Miller was able to cut expenses or improve their operations to improve profit margins. Also, if Asian Pacific growth grew faster than we had initially projected.
I'll start out. Looking at it, given all of your arguments, I really felt that you were very compelling in your point that this was really more of a sell than a hold. So given the run-up that the stocks had, given some of these unfavorable trends that you went through inside, why wouldn't we be more leaning towards a sell on the stock? And it's been a great performer in here. Why wouldn't we be more of a sell recommendation, or what would it take to get to that sell recommendation, given the concerns that you have about this company right now?
I think what would make it a true sell would be something if their sales decreased at a greater rate than what we're expecting. I would say we were relatively modest when it came to what we were indicating for sales growth, and that's what led us to our current valuation level. If for some reason the Posh acquisition does not necessarily go through in 2012, it's expected to at the end of the end of their fiscal 2012. If that does not go through and gets pushed out even further, that could potentially even cost additional funds to continue to pursue that acquisition, which could drive down margins, which could lead to potential sell.
Another point I'd like to add is it's almost a positive thing in a way that their GSA contract is expiring with the government, because right now they give the government up to a 78% discount. So they have very minimal margins on what they're making from the government. So it's actually a little beneficial in keeping us at our whole recommendation.
You mentioned new products are flat. Most of the new products are going to the more favorable markets, home, healthcare, and education. What percent is that?
That was the exact percentage. I'm not exactly sure. I believe in 2011 there were 8 of the 10 products were in the home healthcare education, which was mostly from NetShop. In 2011, I'm not exactly sure.
I think the key there is that only 24%, that segment only makes up about 24% of their total revenue.
You made a comment about, right up front, I think you said that, just clarify this for me, that basically the shareholder value has been realized for 10 years, and that was the basis for your hold recommendation. Is it because, can you just comment, did I hear that right, number one? And number two, can you comment on what that, the last 10 years has to do with where they're positioned today, based on some of the changes they've made, based on some of the changes in their business mix? Can you comment on that?
Okay, yes, number one, you did hear that correctly. I think one of the reasons that we invest is to see an increase. And again, we look back to get an idea of management's ability to retain shareholder value. In this instance, from 2001 to 2011, while we've had some peaks in there, the stock has actually decreased. So going forward, given, again, with Herman Miller being a cyclical business, we just are not confident that they will be able to yield additional shareholder value given the pressure that they're going to receive from a challenged economy.
The trailer, so the point of it is over the last 10 years, basically, it's because management has not shown an ability to be able to bring more, to realize shareholder value over that period of time, gives you little confidence that they'll be able to do it at this point going forward based upon your economic view and based upon your view of the industry itself.
That's correct.
I wouldn't 100% say it's strictly a management issue that, is leading to our indication. A lot of it is the economic factors. We are currently in a very, very slow growing economy. The economy is still rebounding from, the 2008-2009 recession, which, following what what this slide states, if it's at a very, very slow growth, which we are, which has been indicated in the news, it's hard to state that there would be much stock growth at that same time as well.
What about their competitive position? You didn't address, I don't think, much about their competitors.
The ones they mainly, can you go back? The ones they mainly put themselves against are local, because there are other companies, that are global as well. But local, they put themselves against these other three companies, and they all are very good at maintaining the same percent of the market share compared to each other. So they're very competitive in their research and development, the products they put out, what they're spending, and what they're pricing their products for, because they look to each other to see what each other is doing because they're so closely related.
Thank you.
Thank you.
Thank you.